How do you become the face of due diligence-based short-selling hedge funds? Well, first, by becoming an equity analyst and by constantly being spun stories by management. And second, by trying your hand at entrepreneurship in China and failing. These experiences helped shape Carson Block's skeptical philosophy. Looks can be deceiving, and everything needs to be questioned. So when his father asked him to do some due diligence on a US-listed Chinese microcap, Orient Paper, Carson Block knew where to look and what questions to ask. Orient Paper turned out to be pretty much a Potemkin village. While they did have a factory, their outdated and poorly maintained equipment couldn't conceivably support an operation generating the $65.2 million in net revenue the company claimed. There was shockingly little activity at the factory compared to the dozens of trucks carrying paper, chemicals, coal, clay, etc. one would expect in a company doing that amount of business. Moreover, the factory was located on a small country road that again couldn't possibly handle the level of activity associated with a company of Orient Paper's purported size. Plus, their ever-changing customer list really stretched the limits of credulity. Some were small companies unlikely or unable to purchase the massive dollar amounts Orient Paper claimed they sold, while others didn't even have a website and their existence could not be verified. In reality, Block and his team found that the company had inflated its revenue by a factor of 27. The $65.2 million revenue figure in the company's SEC filings was just a smokescreen. The audited financial statements filed in China showing the true revenue amount at just $2.4 million. Block and his team shared their findings with the world, causing the stock price to plummet. This propelled Block and his firm Muddy Waters Research into the international limelight in the summer of 2010. Their next target, in November 2010, was delisted, and 2011 found Muddy Waters on the winning side of a bet against John Paulson, the billionaire hedge fund manager who had become a financial legend after betting against the subprime mortgage lending market using credit default swaps back in 2007. The hedge fund manager lost $500 million after Sino-Forest went under, while Muddy Waters Research further solidified their reputation in the world of short selling. They continued publishing public reports on various companies, and eventually, in late 2015, Block launched Muddy Waters Capital, LLC, and started managing outside capital after receiving an investment of $100 million. Over the years, they have gone toe-to-toe against companies all over the world. Groupe Casino, a French mass-market retail group operating hypermarkets, supermarkets, etc. in France and Latin America. Steuer, a Germany-based advertising company. OSI Systems, a U.S. company specializing in security and inspection systems, etc., and many, many others. Muddy Waters Capital has a good track record, delivering 16% returns in 2016, 15% in 2017, and 20% in 2018. I couldn't find their returns for 2019, but I can't imagine it being that far off their historical average. One interesting aspect is the fact Carson Block and Muddy Waters take an activist approach to short selling, widely disseminating their research on the internet completely free of charge. Recently, I decided to calculate the exact returns someone could obtain by simply writing their coattails. I analyzed the fund's research reports published over a 2-year period between May 2017 and July 2019. Ideally, you'd want to assess past performance based on a full dataset. However, a number of companies Carson Block and his team have crossed swords with over the years, have either been delisted or gone bankrupt, making it difficult for us to reconstruct exact price movements. Similarly, this simulation also excludes recent targets like NMC Health plc and GSX Tech Edu Incorporated, for the simple reason that we assess performance over various time horizons, ranging between 1 month and 1 year. Muddy Waters' report on GSX came out on the 18th of May 2020, so we don't have enough data to evaluate their performance when it comes to this particular name. Although, in all fairness, GSX has been nothing but a headache for short sellers, more than doubling in price since Muddy Waters expressed their bearish view in the public forum. In this simulation, we assume the initiation of a short position at the closing price on the first day of trading following each report's publication. A close to 30% intraday drop in OSI systems skews the data in favor of the longer holding periods somewhat. But even so, the general direction is unequivocal. Muddy Waters picks may take 6 months to a year to play out in the capital markets, but they're generally worth the wait. Past performance is not indicative of future results, of course, but the numbers do appear to indicate that Carson Block's success derives more from the merit of his research than from a short and distort scheme leveraging his visibility in the financial press and on social media. Yet, ironically, in the world of short selling, being spot on can sometimes be more costly than being completely wrong. Take ticker symbol WORX, for example. According to the official website, the company, founded in 2012 and headquartered at an address matching a Regis rental office on Madison Avenue, quote-unquote, offers an advanced software solution for the management of healthcare providers' foundational business applications. On the 17th of April 2020, Hindenburg Research put out a report critical of the company, in which they posited WORX's newly announced deal for the distribution of rapid testing units was in all likelihood completely bogus. The SEC seemed to agree with Hindenburg Research and issued an order of suspension of trading on April 21st, 2020. The stock hasn't traded since, and on June 1st and June 2nd, NASDAQ notified the company that it was not in compliance with rules for continued listing, as WORX had not yet filed its 10K, or annual report, for the fiscal year ended December 31st, 2019. If and when trading does resume, the stock price, which is currently stuck at the April 21st close of $5.76, is likely to collapse, allowing short sellers to realize a hefty profit. Or so you would think. However, by taking a short position, investors incur borrow fees at a certain percentage per annum, irrespective of the trading status of the equity. Depending on the borrow rate, which can at times go well beyond 100% per annum, and the duration of the suspension or halt, short sellers can be directionally correct in terms of the stock price and still lose ungodly sums of money. According to Carson Block, Hong Kong's long trading halts are especially unforgiving to short sellers. The problem with the halts in Hong Kong is that they're very long. So once you get a halt that really stretches out, it becomes negative for many investors because they just won't get their money out. That's exactly what happened with China Huishan Dairy Holdings, on which Muddy Waters put out a report back in December 2016. Trading in the company's shares was suspended on March 24th, 2017, but it took the Stock Exchange of Hong Kong over 2.5 years to delist the stock. And 2.5 years isn't even the record when it comes to these shenanigans. For example, trading in China-Biotics stock was halted in November 2013. The shares were delisted and the company was shut down. However, as of January 2018, Rich Gates and his partners at TFS Capital were still paying stock loan fees on China-Biotics. Apparently, the Depository Trust and Clearing Corporation, or DTCC, Wall Street's clearing and settlement service, continued to maintain an entry on the company, despite it long having been delisted, its shares completely worthless. One way to circumvent these risks is by limiting one's downside exposure through the use of options. Whereas short equity positions introduce uncertainty in the form of sky-high borrow fees, options allow investors to express a bearish view on the underlying equity while risking a well-defined amount corresponding to the option premiums. This solution is nowhere nearly optimal, however, because A, options trading is not available for many good short candidates, and B, premiums are often high, and options trading introduces or exacerbates a number of variables, like volatility and time. I'll continue trying to find ways to mitigate this type of risk, but for the time being, it seems regulators will continue working against, rather than alongside, short sellers.